Sprouts Farmers Market, a fast-growing, really cool chain of supermarkets. Guys, full disclosure, Mo and I both own this, but remember, you should never, ever buy a stock because we own it or anybody else, even Warren Buffett. We're not giving financial advice here. What we're doing is we're trying to teach a process. We're not giving any investment advice saying go buy the stock. So guys, in this video, we're trying to appeal to beginners and advanced people. So if you're either one, stick around for the whole video. We have something in there for all of you. We're going to go over some basic things about each company, Sprouts Farmers Market. We're going to go over bull and bear cases. We have analyst estimates on our site. As part of our software, we will show you analyst estimates. We'll go, obviously, like I said, our 8 pillars are our foundation of our website. And then we're going to use our stock analyzer tool to determine what price to pay today for the company based on the assumptions we're making for the future. So let's start checking out Sprouts Farmers Market. Year to date, it's up 15.7%. It's a $3.7 billion company with an enterprise value of $5.5 billion. So Mo, if we bought all the shares outstanding, it'd be $3.7 billion. Yep. If we bought all the company with all the debt and everything and wanted to write a check to get rid of it all, $5.5 billion. Mm-hmm. I'm actually surprised that that's not. I thought this would be higher because of it's a retail, so they've got a lot of leases in there. Yep. I'm actually surprised. Yep. All right, 1-year PE of 14.7, 5-year PE of 15.29. Look at this profit margin, 3.9%. Mo, can you pull up Kroger real quick? That's pretty good. So I want to show people like 3.9% sounds like it's low, but for a grocer, it's not. Look at this.
5-year profit margin for Kroger, 1.3. Trailing 12-month, 1.7.
So they're crushing it the last 12 months, and it's 1.7.
And this is double that.
So more than double. More than double.
Yeah.
No dividend, which I'm glad, because they only have around 400 stores, so they're still in growth mode.
They are really growing. We'll get to that.
You don't want a company that has a high reinvestment rate, which I think this is subdued, by the way, because of their growth. The 11% return, you don't want them paying out a dividend. You want them to keep snowballing those earnings and revenue. That's what's important here. Don't be upset because there's no dividend. You should be revering this. The only time you want a dividend from a company is if they have nothing better to do with their cash.
Correct.
37%. What's the gross margin at Kroger?
Let's look.
Because that's a thing, too, that I want to be interested in looking at. Oh, my God, look at this.
21.6.
Guys, look at this. 37% gross margin for Sprouts. That means every dollar they bring in, as long as they don't increase their overhead, they're adding 36.7% of that to the bottom line before taxes. I mean, look at Tim. He just said, Kroger's at 21 point. Exactly.
The average supermarket's profit margin is less than 2%.
Oh, yeah, absolutely.
I think it's like 1.9. That was the average a couple months ago.
The concern I'd have with Sprouts is probably somewhere way down the road when they're just trying to appeal to investors saying, okay, how do we get more and more growth? Right. And they start opening locations that, like, remember, I always talk about Borders. Borders, when it was originally pitched, the Borders bookstore, they wanted like 270, they had a very specific number. But then you go public. And then the markets out there go, we want growth. And they start deviating on their numbers. Yeah. And before you know it, they're overextended. Mm-hmm. That's what I worry about long-term with Sprouts. How many locations does Kroger have? 2,700.
Yep.
So Kroger is 7 times larger than Sprouts Farmers Market. I don't think Sprouts Farmers Market is a 2,700 store.
I don't think they want to be
potential.
Either.
I hope not.
Yeah, I think they want to be more in that niche. I mean, their average consumer makes more than 6 figures. So
is that true?
Yeah. So they are that type of store. They're not going for the everybody.
Good. 5-year average free cash flow 273. Trailing 12 months 294. Okay, Mo, get to those bull and bear cases because I want to hear it before we even do the 8 pillars.
Okay, so they're targeting 30 stores added in 2023. They've already opened 21.
Wow.
Yeah.
Okay.
So they're on a good track right now. They have enough cash on balance sheet to purchase 100 new stores at an average of $3.8 million per store. The new CEO, since they've taken over, has bought back 16% of the total shares, or 4% per year, with plans to buy more as the price permits. And that's the most important thing, as price permits.
Yes.
Knows what he's doing.
So we want good capital allocators. Yes. We want somebody who's not going to sit there and say, you know, a lot of people love buying back shares. A lot of companies love doing that because they say, hey, listen, it's only great for investors if you're buying back cheap shares. That's a big, big misunderstanding for a lot of investors. They think just buying back shares is good because now you split the revenue and profit amongst less shares. Sure, as long as it's a no-brainer. Mm-hmm. Not going to lie, this isn't a no-brainer to me, but if they're growing like crazy, maybe it is a no-brainer. Mm-hmm. So I'm not upset about this. Let's go look at their 8 pillars, though. Oh, wait, did you do the bear cases
No, let me talk about bear cases.
Yes.
So obviously, this is a highly competitive field. This organic food and all of these healthy foods is a fad right now. Let's see if it remains, but they're behind Whole Foods, and Whole Foods has a very big footprint in the industry. Sprouts is second. Now, when it comes to the fad, if there is a downturn, I don't really see this as a bear case that people were talking about. People have 6-figure salary. You are going to have people going to cheaper stores, absolutely. But I think that this is one of those companies where maybe it won't affect the consumer as much.
Because their average household income is 100,000 plus.
Exactly. And they say, this is the food I want, and I can still afford it, and great. I'm going to stick with it.
I don't think organic's a fad. And even if it is a fad, I think Sprouts will adjust to whatever the new fads are.
Yeah, I think so too. That was just one of they said fad industry.
Okay.
Maybe.
Cool.
But that fad industry has been around for quite some time.
Here are the 8 pillars, guys. Remember, if you have our software, you can modify your own pillars here, up to 12 and 4 quadrillion plus different variations. I said that right, 4 quadrillion. Okay, here's what we have here. Debt doesn't bother me. That's the 1X because it's retail. They're going to have a lot of leases. Free cash flow is down 44 million in the last 5 years. I don't know why that is. I think it's just kind of surprising. Their 5-year free cash flow. Okay, so they have 5 years ago they did 15 million in free cash flow.
Mm-hmm.
All right, but everything else is a check mark. And this is what I like also. The free cash flow multiple is lower than the PE.
Yep, it's awesome.
Yeah, so they're reporting more free cash flow in the last 5 years than reported earnings.
Yep.
Now, this ROIC isn't insanely high.
I will say, I mean, COVID was tough for them. I think they might be coming off of that struggle. Jack Sinclair only took over in 2019. And
he's the Dollar Tree guy.
He's the Dollar Tree.
Dollar store.
Dollar
99-cent store.
99-cent store. That's
okay,
it.
one of those.
So he's getting things in place. So I that could be skewed. That could be a skewed number. But nonetheless, it's less than what I like to see, 12, but it's okay.
Okay, so guys, there's a lot of positives about this company. There's a lot of growth potential. If the company can grow very fast or grow at a good pace, I shouldn't say very fast, and the stock stays cheaper, they're buying back lots of shares, that's how you get multi-baggers.
Yeah.
All right, let's go see what analysts are saying here. They're expecting $2.50 per share in profit. Oh man, look at this, Mo. It's not as much as we had thought.
No, it's really not.
Actually, I'm kind of surprised by this.
Yeah.
Okay, so $2.50 a share in profit to $3 in 2027. And revenue, boy, revenue is going to be growing pretty solid.
Yeah, I like that growth.
Yeah.
For a supermarket, it's great.
6.78 billion to 9.13. Okay, so now we go to the stock analyzer tool. Now remember, the key to the stock analyzer tool, and the reason it was used 1.3 million times last year by our users, is it allows us to make assumptions about the future and then tell us what price to pay based on those assumptions. You should pay a higher premium for companies that have a solid ROIC and a good growth rate, but every industry is different. Obviously, a company like this is going to grow because costs are going to go up for goods, plus they're going to grow more and more stores. So the question becomes is what kind of growth rate can that happen in the next 10 years? We put all of our assumptions in, revenue growth, profit margin, free cash flow margin. We put our ending PE and price of free cash flow, and then we finish it off with desired return. Mm-hmm. Now, guys, all of this, plus all of these tools are available at everythingmoney.com, $7 for 7 days as your trial run, $1 per day. It includes the community here, thousands of investors talking about investments. It's a great way to engage. So everythingmoney.com, $7 for 7 days. Check it out. Now, Mo, I think 10-year analysis is a great analysis for the stock. Too. So give me some revenue growth numbers, amigo.
What do you think about 3, 5, and 7?
I fucking love it. What about profit margin?
Why don't we go 3, low side, 3.5 and 4?
How about this? 3.2.
Okay.
3.7.
Okay.
4.2.
Okay.
And the reason being is, even though we've never seen this, would it be a big stretch to go all of a sudden hit that?
We've also not really seen 3.7.
Exactly. That's like the 10-year average. Exactly. That's why I'm looking at going, okay.
Yeah.
All right, free cash flow margin. Look at that free cash flow margin. I love it.
Would you go about the same?
And by the way, here's why I think the earnings and free cash flow are different. As they're growing more and more stores, they're depreciating those stores very fast. So the cash is going to show a much higher number than their profit margin because there's probably a lot of, and I'm speculating here, but there's probably a lot of depreciation in here from the new stores they're opening. So if they spend $3.8 million opening a store and they open 30 stores, that's $115 million bucks. if they can depreciate that over 7 years, every year they get an extra almost $15 million, over $15 million a year in extra write-off. And that's the reason why.
Yeah.
Okay?
Yeah.
All right. Free cash flow. What were you saying?
What do you think about going the same? Or do you want to do a little bit higher?
But their free cash flow is better.
Well,
let's do this, Mo. Let's do 3.5, 4, and 4.5. Okay. Because I do see that. I see 3.5.
Yeah.
I see 4.5. So let's just split the difference.
Okay.
Okay. Now PE.
14, 16, and 18?
14, 16, and 18. Same with free cash flow?
Yeah.
Okay. Now, desired return. Guys, you can get 9 or 10% by investing in the market, right? Your desired return should basically be your margin of safety. The higher your assumptions, the higher the return you need to justify that. Because the more return you need, the less price you pay. So I think Mo and I are going to disagree on this one. What do you think for desired return?
I was going to go 10, 12, and 14, but I could see going a little bit higher too.
That's where I feel.
I think I can go, I was thinking 11, 13, and 15.
See, I agree with that, and here's why.
It's still a $3.7 billion company. It's
I actually was going to say 12, 13 and a half, and 15.
I don't disagree.
I'm going to do that. 12, 13 and a half, 15. It's still a small company.
Yeah, there's still risk. There's more risk here.
So I'd rather have a little bit more margin of safety. Now, to that point, though, you only put a 14 PE in here.
Yeah.
But, guys, I'm going to hit the analyze button. A bunch of numbers are going to pop up. There's going to be a value, 3 values based on earnings, 3 values based on free cash flow because of low, middle, and high. But there's also going to be 3 values that are going to be based on if you paid the price today for the company, which is right up here, $35.74. What return would you get for each level that occurs? That's the big key. That's something we added recently. It's very popular. It can tell you today, hey, you pay this price today, you're going to make something. Here's what it's going to be. Stay with me throughout the entire video because there's not going to be much left afterwards. And we're going to probably talk about these numbers a little bit. But the stock's currently at $35.74. Low price of 25, high price of 39 or 42, middle price of 31 to 33.
Okay.
If you pay today's price of $35, the low assumptions occur, you're gonna make 7.5%. Middle assumptions occur, 12.5%. High assumptions occur, 17.5%. And I have it on my watch list at $32. So remember, guys, one of our benefits in the software is you can add it to your watch list and it'll notify you on email, on phone, and on your app about when the stock hits that price so you can decide what you're gonna do with it. All right, so guys, everythingmoney.com, $7 for 7 days, $1 per day. Go check it out. Thank you very much for your time.